Hello there, and welcome to Module 8 of the Income with Options program. Again, like I talked about in the PDF for this module, I'm not going to go into every single detail of fractal energy trading. I'm just going to very briefly summarize the benefits of the four main rules as they apply towards selling cash-secured puts, as well as doing covered calls. So we'll start off with rule number 1, which is that larger time frames dominate the trend. When we talk about a larger time frame, typically what we're talking about is something on the order of a weekly trend for at least the trades that we're doing. It depends, again, on your fractal relationship. If you're doing day trading, then an anchor chart might be something as simple as a 5-hour chart if you're trading off the 12-minute. However, in this case, since we're going to be selling puts, which are going to be relatively distant out of the money, we're going to be using this more as swing trades. So we're going to be talking about the weekly chart as the larger time frame. So you can see here, and then in the rally that started off early 2016, all of these pullbacks eventually reverted back to the mean, and that was the larger weekly trend. So you can see that this played along very well until it stopped playing, which goes along into rule number 2, which is that reversal start from the inside out. But we don't want to get ahead of ourselves here. All we want to do is we want to identify when we're in a larger primary uptrend on the weekly chart. So you can see that this one lasted for quite some time, even though every pullback makes it seem like it's all over. The party's over, the party's over. But then surprisingly, it reverts back up to the mean once again. So we currently have, at least as of today, still a primary weekly trend to the upside. So in today's environment, we should be looking for pullbacks with which we can sell puts against for rule number 1. Now, going back to the previous bull market, so this is 2016, 2015, even to some degree, right? So most of this was in 2017. So you can see how each of these strong pullbacks, though, even though they felt at the time like this is it, this is over, it's all over and done with, each of these reverted back to the mean, which in this case is a larger weekly trend. So you're going to see this pattern over and over again. And the judgment that you need to be able to figure out is which of these, again, you can see that even if you sold at this one, and if you're wrong and it came back again, you still had many, many chances to get out of this trade, or perhaps be assigned the underlying, which again is one of the requirements for doing the trade. But you can see again and again how the price pulled back and then eventually got reverted back up to the mean, to the major trend. This pattern occurs all the time, and it surprises most people because what they do is they get caught up in the minutia. They got caught up in the candle of the day. They get caught up in the crowd who is going to freak out if they see the price going from 7,500 down to 5,700. This is it. It's all over. Social media is going to light up that the bull market is over, and people are going to start taking short positions. However, you're going to take the opposite side. This is where you're going to sell the put and then watch that short put almost immediately go into profitability. Now, also keep this in mind if you're setting up short calls for the covered call position, because these trends can get very, very strong and you can get run over with. So this is where we typically, if we're going to be selling covered calls, we go down to rule number 4, which I'll get to in just a minute. But rule number 1 works very, very nicely for the establishment of the cash secured put position, pullbacks in the middle of a major trend on the weekly chart. Now we get to rule number 2, which is the converse of rule number 1. Rule number 1, of course, is that larger time frames dominate the trend. However, change starts from the smallest time frames. So change meaning a reversal will start from the inside out or the smaller time frames. And then if there is anything beyond that reversal, more than just a pullback, we'll start to see that propagate to higher and higher and higher time frames until it is truly a change in polarity that we have a larger time frame downtrend instead of an uptrend. So let's go over to the charts and see how we apply this towards cash secured puts and covered calls. Here's the daily chart. And if we look at this chart, where we have a weekly uptrend via rule number 1. We know that we want to be selling into pullbacks, but where does the pullback end and the new trend begin? When does this thing actually revert back to the mean? And this is where we can use smaller time frames to really nail these with a lot more accuracy versus just saying, oh, okay, there we go, there's a pullback, and then we end up having to chase after it. We lose a lot of edge on that cash secured put position. And by the same token, if we're selling a covered call, sometimes we want to wait for this thing to actually show us that it's setting up into a corrective pattern, unless we really don't care and we don't mind being called out. So our short call exercised, and then we have to surrender the underlying coin, in this case, perhaps Bitcoin. Normally, we don't want to do that. We want to use covered calls to augment our returns and not necessarily surrender and take profits on a covered call. So using rule number 2, we can go down to a smaller time frame. And this requires you to understand how the puzzle pieces kind of fit together for this. So we can look at a couple of reversals that we've had here. This is a particularly good one here. So we have the 5-hour chart in this case was a former uptrend with higher highs and higher lows, and all of a sudden starts going into a lower low and a lower high. And it looks like it's transitioning into a downtrend, which it is at this time frame. It's just a pullback on the daily chart. However, what happens is it prints a higher low and eventually a higher high. That is a change in polarity back up to the uptrend, or to an uptrend at that point. And this is where we feel that there's a good possibility that a bottom has been put in, and this is reverting back to the mean once again. And in fact, this is exactly what occurred from there. So we have another more recent version of this, where again, downtrend with lower highs and lower lows. And then we start to see the price putting in higher highs and higher lows. So the reversal happens right around here at 10,000 and leads to a very nice rip to the upside. So we're always trying to find these. We're always trying to find these reversals. There's so many things that we can do with them, obviously, besides just cash secured puts. But a little bit of edge never hurt anybody on the way into a trade. Now we can do the same thing with the covered calls. If we're looking to sell a call, we don't want to necessarily step in front of the freight train here and sell a call just because we can, or because it's above resistance, because resistance can get blown over. So if we sit down at the 5-minute chart and we say, well, let's wait for this to show a lower high, and it starts to do that right around in this area. This is where the formation of the lower high is, and then it prints a lower low from there. So right around here would be a great place to sell a call, although to some degree we've lost some of the edge. But if we could sell that for 14,000 or higher and still get a decent return, then you can see that as the market slips into corrective, even though it doesn't necessarily come back up and retest that, this is the time value. All that time where the price is just consolidating is where we're putting it to our advantage. So that is rule number 2. We can spot reversals faster at a smaller time frame, and they start to propagate higher. Even if it doesn't turn into a full-on downtrend at the larger time frame, normally it's just enough for that option to be able to expire out of the money. Remember, it doesn't have to go down. All it has to do is not attack and keep going to the upside. And then we don't have to worry about any kind of assignment if we're selling covered calls. So again, that is rule number 2. Reversals start from the inside out, and then they propagate higher in time frame. Now we get to rule number 3, which is a relatively simple rule. Descending patterns break to the upside and vice versa. So this also means that ascending patterns will break to the downside. So this has to happen anytime we have a trend. Unless that asset is going to go all the way to 0, at some point, this descending pattern will break to the upside. What goes down must go up at some point, unless it's going to go to 0. By the same token, unless we have an asset unless it's going to go to infinity, at some time, that ascending pattern will break to the downside. And as you can see, we can play rule number 2 sort of in conjunction with rule number 3 here. Here's that 5-hour chart that we were looking at, and here is a descending pattern on the 5-hour chart, and eventually you can see this trend line that we've got illustrating the trend, and eventually this descending trend gets broken to the upside. And we can play this game. Here's another ascending pattern which gets broken to the downside. I mean, we can go back and forth on these. And a lot of people sometimes will have problems with this because they'll say, well, it's not, you don't, it's subjective. You don't know where that trend line is going to be. And we can draw this in different places and we can argue over where it is. But at the same time, eventually, no matter how you draw that pattern, it will get broken to the upside. If a descending pattern is going to reverse, it will break that trend line. So again, how we can use this with rule number 2 is that notice that I'm using a smaller time frame here. This is a 5-hour chart. And around the same time that this starts to show a change in polarity and a reversal, we have a break in trend line. So we can use these two rules to sort of strengthen each other and add a little bit of confirmation. If you think it's reversing, you may not want to take that signal until you truly do see a descending pattern break. So that is rule number 3. Descending patterns break to the upside. Ascending patterns break to the downside eventually. And that leads us to rule number 4. Range contraction leads to range expansion. And the converse of that is that range expansion leads to range contraction. So one way to look at this is just that when we have a trend, range expansion is eventually going to lead to some form of range contraction. And just when we think this thing will never trend again, range contraction will lead to the next range expansion. And that contraction could actually lead to expansion in the opposite direction, depending on what we have with the price fractal. So a larger time frame might be at exhaustion, and this may be what the chart wants, is to go on a larger pullback. So this is what we're going to look at all the time, this sort of oscillation between range contraction, range expansion, range contraction, range expansion. It never stops. It's always going on constantly. So if we can figure out what phase it's in, whether it's in expansion or contraction phase, this will help us understand how to analyze this. When we just look at a standard price chart, this is a daily price chart of Bitcoin, it's kind of difficult to figure out with any sense in terms of, especially if we're looking at the hard right edge here, is this an expansion or contraction? Well, it's an expansion for right now, and then eventually it moves into contraction. But we don't really know that until after a few bars. So what can help us is to actually add a study which can somewhat quantify this whole notion of trend, and this is where we use the CHOP index. In this case, this is applied to the RSI Laguerre, or we can just simply add the CHOP index by itself if we want. What I'm looking for is the yellow line here. And when we have high values that are higher than 55, typically this is when we have the potential for a consolidating market, which it's obviously doing at that time. There's the only reason for it to be high. We'll start to move back into trend fairly soon. And then the converse of that is that when we have total and utter exhaustion, a very low value, especially anything below 25, this is typically when we have markets that are not going to run that much further before they move into consolidation. So we should start to see some applications that we can use this for cash secured puts and covered calls. One of the easiest to think about is when you're at exhaustion after this price goes completely berserk to the upside, and we show an exhaustion figure here. This is probably a really good time to set up a covered call, the short call for the covered call, because you're much more likely to run into consolidation at that point. However, one little tip here, when we do have a very strong market, we typically will want to wait until we get a weekly exhaustion signal. A weekly exhaustion signal will allow us to sell that. So in this case, we have not only weekly, but also the daily exhaustion signal at this point, and it was right over here. So this improves our ability to sell covered calls at this point and not get called out. So again, that is my assumption, is that most of you want to acquire more and more and more Bitcoin. You want to continue stacking these positions for a longer time frame, and you don't want to necessarily surrender it. So you got to be very judicious about the sale of a short call option. Now, about the cash secured puts, when we do have a strong market like this, we're not going to get exhaustion signals to the downside on the daily chart. Probably the best that we're going to see is maybe a 5-hour exhaustion signal to the downside. And so you can see there's a couple of them here on the pullbacks. These would actually be very good signals that we could sell against to sell. This is an upside exhaustion, but some of the exhaustion signals that show up here to the downside, really there's only one of them that I'm seeing right now, which is right there. So you can see at this point we have exhaustion on the choppiness index, and we obviously have a trend to the downside. So this would be a good sale of a put option at this point on that pullback. Is it the exact bottom? No. You're just stacking up probabilities in your favor. And you can see that this trend to the downside did eventually go sideways. Range expansion goes to range contraction, right? So we don't have any other really strong pullbacks that show up around this time, although we may be looking at one here fairly soon that we can sell against. So again, I hope this all makes sense. I mean, this is just kind of to wet your whistle in terms of what you can do with the 4 rules of fractal energy trading. And it will allow you to add a little bit more precision to your trading instead of an arbitrary entry where it just sort of feels good, which typically at some point sooner or later, trading based on feelings is not going to produce a very good result for you. So if you find this interesting, if you find this useful, please comb the resources that we have in the Fractal Energy program, the actual trading masterclass that we have within Ready Set Crypto, if you want further depth on that. Okay, guys, we'll see you in the next module where we'll discuss risk management. See you there.